Hey guys, welcome to Talking Money with NYSE, personal finance made simple. Today I'm going to be talking about the pros and cons of investing in shares, as well as the pros and cons of investing in ETFs, also known as exchange traded funds, and why I still think that ETFs are a great investment option. Let's start with shares. What is a share or a stock or an equity? A share, also known as a stock, also known as equity, is a unit of ownership in a company. When you buy a share or a stock, you are buying a small piece of ownership in the company. As a shareholder, you are entitled to some of the company's profits and assets, as well as the right to vote on certain matters relating to the company's operations. The value of a share is determined by the market, and it can go up and down based on certain things like the company's financial performance as well as market conditions. So what are the pros of investing in shares? Pro number one is that shares can give higher returns than other types of investments, especially over the long term. Pro number two is ownership. When you buy a stock or a share, you own a small piece of the company and you are entitled to some of the company's profits and assets. Pro number three is capital appreciation. The value of stocks generally rises over time, which leads to capital appreciation. This means that if you invest long enough, you can sell your shares for a higher price than what you paid for them and make a profit. Pro number four is dividend income. If you buy shares that pay dividends, they can become a source of regular income. What are the cons of investing in shares? Con number one is risk. Stocks are generally considered riskier than other investments because the value of a stock can fluctuate, meaning go up and down widely, and the company can also go bankrupt, like as in go out of business. This means that you could lose your entire investment. Con number two is investing in stocks is time consuming. If you are buying stocks on your own, you must research each and every company to see how profitable it is before you buy it. You must learn how to read financial statements and annual reports and follow your company's developments in the news. This takes a lot of time. Con number three is that the share prices rise and fall all the time, and this causes an emotional roller coaster that makes many people buy and sell shares at the wrong time. Investing in the stock market requires strong emotional discipline, which a lot of us lack. You won't believe it. Now, let's move on to ETFs. What is an ETF? An ETF is a type of investment fund that holds a collection of shares or stocks or other investments and can be bought and sold like a stock on an exchange. Think of an ETF as a fruit salad of different shares. In a fruit salad, you get pieces of apples, oranges, bananas, pineapples, grapes, etc. in one bowl. ETFs are a fruit salad of shares. For example, the South African Top 40 ETF is a fruit salad of shares including Vodacom, Shoprite, Capitec, Clicks, MultiChoice, Woolworths, and up to 40 of the largest companies on the Johannesburg Stock Exchange. The value of an ETF is closely tied to the performance of the shares that it holds. If the shares in the ETF perform well, then the ETF will go up in value. But if the shares in the ETF go down, the ETF also goes down in value. Also, the overall state of the stock market and the economy can also affect the value of ETFs. Let's start by addressing the cons or the disadvantages of investing in ETFs. The first con of investing in ETFs is the fees and costs. Even though investing in ETFs usually costs less compared to investing in actively managed unit trusts, you still have to pay a fund manager to manage the shares that are in the ETF. But those who invest in individual shares by themselves, they don't need to pay any management fees. The second con of investing in ETFs is limited control. Because ETFs are baskets of shares, as an investor, you don't have any control over the specific shares that you are investing in. You just get a whole bunch of them and you invest in them if you buy an ETF, whether you like it or not. The third con of ETFs is market risk. ETF performance is determined by the performance of the shares that are in the ETF basket. If you buy the S&P 500 ETF, for example, which is a basket of the largest 500 American companies, and the S&P 500 goes down by 50%, your investment portfolio will be affected as well, right? Having said all of this, ETFs are still a great option for investing. Let me explain why. There's a lot of research that shows that over long periods of time, stock pickers or active investors, those who try to choose individual shares for themselves, usually have poor returns compared to those who invest in a market index like the S&P 500, for example. One reason why stock pickers underperform is that it is difficult to consistently identify and choose shares that are going to perform well in the future. Many stock pickers use historical or past information to try and identify potential investments. But just because a stock performed well last year, it doesn't guarantee that it's going to perform well in the future years as well. Another reason why stock pickers underperform is that stock picking requires a lot of research and analysis, which can be very time consuming, and most people do it incorrectly or they don't do it at all, and therefore not properly researching can result in choosing the wrong shares, which causes poor returns, making it difficult for stock pickers to beat a market index like the S&P 500 over time. Also, there is a problem of human emotions and biases which interfere with how investors make decisions and can lead to irrational choices. Guys, we are emotional creatures and our emotions betray our decisions. We usually choose the stocks that have already risen, right? So we choose stocks after they've run up and we sell stocks after they've gone down. So our emotions really interfere with our investments and the outcome of our investment choices as well. Another thing is it's impossible to beat the market consistently after taking into account transaction costs and taxes. The more you buy and sell shares, the more costs and taxes you attract to yourself. Basically, stock picking is difficult and costly and is often wrongly influenced by our emotions and biases. That's why index investing by buying low-cost diversified ETFs tends to be a more effective approach for achieving your long-term investment goals. So now let's talk about the pros or the advantages of investing in ETFs. So when you buy an ETF, you are investing in a diverse group of shares with just one single transaction. You can think of each ETF that you buy as a mini portfolio, a basket of many shares. This simplifies buying shares so that you as an investor don't have to buy many shares one by one and pay transaction costs for each and every share, right? Another benefit of investing in ETFs is the low costs. Because ETFs are passively managed, they generally have lower expense ratios compared to actively managed unit trusts. This means that more of your money goes towards earning returns instead of paying management fees. ETFs also offer diversification benefits. Because ETFs have a wide range of investments in the basket, they can help spread your risk across different sectors, across different industries, and even across different countries. This gives you protection against a stock or a sector or a country performing poorly. In conclusion, guys, ETFs are a great investment option if you are looking for flexibility, low cost, diversification, and an easy way to invest in the stock market. For me, ETFs win hands down, and when I invest, I allocate most of my money to ETFs. So I know that stock picking generally is very hard. Even though I do have shares in my portfolio, the shares in my portfolio only make up 20% of my portfolio. The rest, which is 80%, is in ETFs. Because guys, I've seen the research. The research just shows that as individual stock pickers, we are bad at picking shares. So anyway, why do I buy shares? So a lot of people always say, okay, if shares are such a bad idea, why do you still buy them? Well, the honest truth is because I'm curious. I love doing research about companies. So basically, buying shares scratches an itch, the curiosity itch. So I'm curious. I want to see, if I buy this company, what's going to happen in the next 5 years, 10 years, etc. But at the same time, I'm acknowledging my shortcomings. I'm acknowledging that, I might not be as smart as I think I am. Probably I'm not as smart as I think I am. And I could be very, very wrong with my stock picks. And that is why the ETFs make up 80% of my portfolio, because I'm not trying to play Russian roulette with my future, right? I'm trying to keep it safe. And the way I'm going to keep it safe is that if 80% of my money is in a safe, diversified, low-cost environment, then I should be fine. Okay guys, that's it for today's video. I hope that this video has been informative and helpful. If you have any comments or questions about investing in shares versus investing in ETFs, please leave the comments in the comment section below and I'll get back to you. Also, if you want to start investing in ETFs or shares, please go to my online store to get a copy of my ebooks for beginner investors. See the link in the description and comments below. Thank you for watching. Please remember to like and subscribe. I'm going to see you in the next video.